Hello everyone, it's Professor DLEE with answers to your most pressing personal finance questions. In episode 2 of my video, I thought I would discuss the debate of traditional versus Roth. As I mentioned in my first video, both the traditional and Roth 401k, because of their tax benefits, are superior to saving for retirement in a normal brokerage account. But if you want to determine whether a traditional or Roth is better, we should first define what each of those mean. A traditional 401k, you get the tax benefit up front, and then you pay taxes later when you withdraw from the account in retirement. A Roth account, you don't get the tax benefit up front, but instead you get it later when you make a withdrawal because all of that withdrawal is tax-free. Both the traditional and Roth share the benefit in tax-deferred growth, meaning dividends, interest, and capital gains inside a traditional or Roth 401k are not taxed in the year that they are made. So practically speaking, if you're in a low tax bracket today and you expect to be in a high tax bracket in the future in retirement, you want to save in a Roth 401k so that you pay taxes at the low rates here and you withdraw and avoid taxes at the high rates here. Now if you reverse the two and you're in a high tax bracket today and expect to be in a lower tax bracket in the future, then you should save in a traditional 401k so that you avoid the tax here and you pay the tax here at the lower tax rates. One practical way to determine whether you should save in a Roth 401k is to look at statistics. On average, women reach their peak earning years at age 44, while men reach their peak earning years at age 55. And so if you are, say, in your late 20s, maybe early 30s, on average, or at least statistically, you're likely to increase your earnings in the near future. And one way to determine whether you should save into a traditional 401k is to look at how much you're earning today compared to how much you expect to need in retirement. As an example, let's say that your combined income with your spouse is $400,000 today, but you expect to only need about $200,000 in retirement. In that scenario, it could be reasonable to think that you should save in a traditional 401k account because your income needs in retirement will be lower. Some other practical considerations is if you plan to retire early, in which case you will have a number of years, say in your 50s, where your income is expected to be very low. In those scenarios, you can do what's called Roth conversions, which is essentially prepaying tax by converting from a traditional 401k to a Roth 401k. That will allow you to pay the taxes on those pre-tax contributions at relatively low tax rates. Another consideration is if you plan to move states in retirement. State tax can be as high as 13.3% in California to as low as 0% in, say, states like Texas, Nevada, Florida, and Washington. And so if you're going to be moving from California to one of these low or no tax states or vice versa, that's a consideration you want to make on whether to save in a traditional 401k or a Roth 401k. For a more detailed analysis of the traditional versus 401k debate, I've included a link to my website where I've written an article, a blog post, on this very subject. If this video was helpful, make sure you click on like and subscribe, and make sure you follow me on Twitter and Instagram as well. Next week, I will be discussing the power of mega backdoor Roth contributions for all you high earners out there. See you next week.